Welcome to Bullshift, the podcast, where we talk about personal finance with a lens of actually looking at things through behavioral finance and behavioral perspectives. I'm John DeGuy. I'm the author of the book Bullshift and also the host of the podcast. Welcome. My guest this week is Tim Huver. Tim is the head of B2B distribution for Vanguard Investments Canada. And prior to that role, he was the head of product for the Americas region. He joined Vanguard in 2000 and has held various roles in the United States and the United Kingdom, working with Vanguard's global product platforms and intermediary channels for more than 15 years. Tim Huver, welcome.
Thanks for having me, John. Good to speak with you again.
It's always a pleasure speaking with people that I think of as industry leaders and people at the vanguard, of the industry. And so it's a real pleasure for me to have you on as well. I want to begin by talking about Vanguard. The people watching, the people listening, probably if you're listening to the podcast, you probably know about Vanguard because you're familiar with the firm's founder, John Bogle. But the firm is a global colossus, and it does a whole lot of things. It's more than just the things that you probably thought you knew about it. So what would you say, Tim, are maybe the two or three things that Vanguard's best known for?
Yeah, so once again, John, thanks for having me. I would say in terms of Vanguard, when most people think of Vanguard, they likely know Vanguard for low-cost passive investments. And while our founder, Mr. Bogle, certainly was a pioneer in indexing and in low cost, most investors may not know where that low cost originates from when we talk about Vanguard. And really, that is from our unique ownership structure. And so first and foremost, Mr. Bogle believed that an investment management company should serve investors, directly align its mission, its interests with those that are investing in its funds and later on its ETFs. And while this notion probably seems reasonable, he actually structured the company in a way that achieves that aim. And so for Vanguard, the investors in our funds, in our ETFs, they own the company. Mm-hmm. And so, when you look at other ownership structures within the marketplace, it may be a management company, it may be a family that shares in the profits. That's different from Vanguard. And so for us, when we generate any profit, any revenue, it goes to one of two places. Either we reinvest back in the business to improve our client experience, or it's provided back to end investors in our funds, shareholders in our ETFs, in the form of lower expense ratios. So really, the goal is to enable the investors in our funds to share in the economies of scale. As we grow, as we generate profits, we'll continue to drive down the cost of investing for our clients. So very, very unique. It's likened to a mutual ownership structure, likened to a co-op. I think would be the closest thing to the type of structure that Vanguard has. Mm-hmm. So it's something that's very unique in the industry. And I think it also not only directly aligns what we do with the interests of our clients, but it creates a long-term perspective as well. If you look at our products, we don't chase fads, we don't chase short-term themes, really enduring investment merit, and we're consistent in the way I think that we operate in the best interest of shareholders.
Right. It's funny because one of the things that Mr. Bogle was very fond of saying is you get what you don't pay for. And investment products are, to my mind, unique in the marketplace because in almost any other thing, if you're buying a computer, if you're buying a watch, if you're buying a shirt, if you're buying a car, most of the time price correlates with quality. And the higher price product generally is the better product. But on the investment side, because you get what you don't pay for, the more you pay for a product, the less you get to keep yourself. And so investment products are a bit counterintuitive in that they may be the only products that I'm aware of anywhere where oftentimes the best products are the cheapest. And that's a bit of a sort of a head tilt that people don't always think of.
That's exactly right. I think it's a misconception that the more you pay, the more you get. But you often with investments, you don't get what you pay for. And we see that on the active side specifically in terms of active management. And it creates a higher hurdle for that active manager than to outperform that higher expense ratio. And at the end of the day, it takes returns away from end investors that over time compound and become very meaningful to the overall return of a portfolio.
Exactly. So I should point out that I sent a copy of my first book to Mr. Bogle in 2003, and right around Christmas of 2003, he sent me a handwritten personal note thanking me for having sent it. So it was, I was thrilled. I still have that note in a little frame on my desk, so that when clients come by, when people come by, I can actually say, hey, I got this from Mr. Bogle. But what was especially exciting for me was I got a chance to make the trip down to Malvern in the autumn of 2017, and I had an hour-long meeting with him just personally. So it's funny because when we talk about the impact of Vanguard on the marketplace, I have a real affinity for everything Mr. Bogle stood for, and got a chance to actually spend some time with him before he passed on.
Certainly revolutionized the entire industry, and we hear of so many gestures similar to this interaction that you've had, John, whether it's crew members, employees at Vanguard, or externally with others in the industry. So it's great to hear. Not surprised.
Yeah, exactly. So I'm wondering if you can tell the people listening in about the so-called Vanguard effect. Not everyone would be familiar. People are familiar with Vanguard, but they're not familiar with with the Vanguard effect. And I know that you should know that before Vanguard came to Canada, I was one of those people who was lobbying actively, asking Vanguard to come to Canada to distribute its products because I wanted the Vanguard effect to kick in. So I'm wondering if you can maybe explain this for people.
No, and we appreciate the support there as well, John, before we were here 11 years ago. But as I mentioned, low cost for us isn't a pricing strategy. It's really part of our DNA. It's the result of our structure. And so what we tend to see that when we've seen this when we enter new markets outside of the US, we've seen this in the UK, we saw this in Canada, before we even have launched products, but it's become publicly known that we are entering the market, or that once we are officially able to disclose that we're launching products, what we tend to see is an entire industry react to Vanguard by bringing down their costs in preparation to compete with Vanguard and our entry into that market. And so when we talk about the Vanguard effect, it's really the positive impact that we have had, not just for our investors, but for all investors in the industry, and really the disruptive force that we've been able to really be within the marketplace. And so we've seen the quantifying, and have tried to quantify internally as well, the impact that's had for investors, the savings that once again compounds in their portfolios. And just for those investors in our funds and ETFs here in Canada, through the lowering of expense ratios over time, that's led to millions of dollars in savings for Canadians. And if you look globally, we've seen some external sources start to try to calculate the Vanguard effect for the millions, tens of millions of investors that we have. And that works out to a number that's it's hundreds of billions of dollars, and approaching the last number that I saw, potentially approaching $1 trillion. Not an exact calculation, but it just shows the effect that Vanguard has when entering a market. And we're happy to play the role. If that's even for investors competing products, that's a great win for the entire market and for investors across Canada.
I know that Eric Balchunas has a book out about that right now, so I think this is a book that I'll see if I can pick it up over the holidays as well, and over the next little while, because I think a lot of people are coming to realize just how monumental the impact Vanguard is, and a lot of people hadn't really thought about it. I think some people have, but not everyone, and it's just interesting to think about how people need to come to terms with this is a firm that is quietly revolutionary. Vanguard is a firm that has done things that seems like it's not a big deal, but it's in fact a very big deal. And I think it's especially a big deal in Canada, where we have a lot of let's call it oligopolistic competition, where we have, if you want to get a phone plan, you've really only got 3 providers that you can deal with. If you want to do some banking, you've really only got 5 or 6 major national Schedule A banks that you can deal with. And so in the early days for the ETF market in Canada at the turn of the millennium, there were only 3 or 4. But now we've got, I think, over 24 and maybe even closer to 36 exchange traded fund providers in Canada. And I think the fact that you've got Vanguard keeping people honest with regard to their pricing, and that many entrants into the system providing variety, not just on the low-cost beta replicated benchmark at a low cost, but also a whole host of active strategies and value propositions and ways of slicing and dicing the marketplace. It's really good for the end unit investor.
Yeah, and happy to, as I mentioned, happy to play that role. And we when we look back to our entrance into this market specifically, we did recognize that Canadians pay some of the highest fees for funds in the developed world. And so, we thought we could provide an alternative, and we're here to do that and to hopefully create competition and help disrupt an entire industry.
Sure. So one of the things that I think the people at home might not be aware of is that Vanguard isn't just about passive indexing, that there are several active strategies that Vanguard has that complement their passive ones. Can you tell me maybe why Vanguard has decided to do both?
Sure. And so many people, while known once again as a passive provider and really a pioneer in the indexing space, I would say many people, many investors may not know that we have a really large actively managed franchise as well. And so our first funds ever, Vanguard, our first funds were actively managed prior to having passively managed funds. We have almost $2 trillion under management in actively managed mandates. And so if you look at that, that's just to equate that, that would be equivalent to the entire size of the Canadian mutual fund industry here. So very significant, very substantial. We do call it the $1 trillion secret because, to your point, I'm not sure many people would know that that we have that type of presence in the active space. So third largest active manager. We believe that active and passive can play an important role within a portfolio. And so when we talk about passive, just to clarify terms, you're buying the market and all the securities within a particular market. And so that might be a logical starting point for many investors, but we also know that there are other investors that may be more comfortable with taking on greater risk in seeking that outperformance. And in the marketplace here, we do see investors using active and passive together in combinations, and know that that's certainly relevant to a portfolio. And we also know that you can achieve success in the active space. Now you need what we would say 3 important factors: talent, cost, and patience. Those will be your key drivers to success in actively managed mandates. So on the talent side, being able to identify the best managers in the world, skilled managers, and we think we have a really good process and team of almost 30 individuals that do that. We have managers that want to partner with Vanguard because of our size, because of our scale. We have long tenured managers that we've built long relationships with. So I would say talent, cost, we talked about. You don't get what you pay for, and it tends to work against you actually in the opposite, where higher fees create a higher hurdle in the active space, and then patience, because we know that there will be periods of underperformance on that path to outperformance as well. So we believe both can play, passive, active, play an important role in a portfolio. And we also think what we're bringing here is another disruptive force for investors on the active side.
Right. Right. I want to shift gears, but right now we've been talking just about products up until now, but I wanted to talk a little bit about advice as well. Several years ago, Vanguard put out a paper talking about the notion of advisor's alpha, about the value of advice. And I'm wondering if you could maybe just give us a brief summary of what that paper covers off. You can probably say it better than I could, and then I've got a few questions for you about it once we're setting the stage.
Sure. So, Advisors Alpha originated, when I think about when that started, probably almost 2 decades ago, if not longer. And it's become, over that time period, a really widely recognized and referenced piece of work in the industry. And so what Advisors Alpha really was, we believe that financial advisors play a very important role. They add a considerable amount of value to the clients that they serve. And we really wanted to calculate and to quantify the value that advisors can have for their clients. And so alpha, we often think of alpha in active management. That is the outperformance attributed to the manager above and beyond the benchmark. We see it with advisors as well. And I think many investors automatically go to the investments when they're thinking about the value that advisors have. But what we find is that the real value is provided within those holistic wealth management themes. It's the behavioral coaching, it's the tax and estate planning, it's the rebalancing. So it's really beyond just the investments. We find that the holistic financial planning and those aspects to the advisor's practice are really the driver of the alpha. And we've quantified this to a value of over 300 basis points. So advisors adding over 3% in terms of return to end investors or clients that they serve. So it is significant when we think about that. And it's when we look at the largest piece to that, it is the behavioral coaching as well, John, and that's an important aspect. It's the human element of the financial advisor relationship that you can't outsource to technology or to digital, and that makes up more than half of that 3%.
One of the things about the Advisors Alpha paper and concept is when you disaggregate the various things that make up that 300 plus basis points value add, one of them is recommending low cost products. And I wanted to maybe explore the notion of how things are framed. So a lot of what I talk about in the book Bullshift and in the podcast is behavioral biases that we have, and one of them is framing. So the notion of adding value by using low cost products, you can say, well, if you use a product that costs 70 basis points less, all else being equal, that's 70 basis points of added value. What would you say if someone were to push back and say, well, what if we just use the low cost product as the default, and instead of adding 70 basis points of value by using the low cost product, we subtracted 70 basis points of value by recommending a high cost product? It's the same thing. We acknowledge that there's a 70 basis point delta between the low cost and the high cost. How would you respond to that observation?
Yeah, so I would say that, when we look at the components of Advisors Alpha and what's attributed to that move to lower cost product, we get to an assumption of 30 basis points overall. And so I would say that while that is, cost is an important factor and can certainly help lower the cost of the overall portfolio, we do find, I'll just go back to, we do find that the value adds are within those other wealth management themes and go well beyond just the movement to low cost product, although that is certainly a component. And I'm sure that the differential in many cases might be greater than the 30 basis points as well in terms of adding return to end investors. But I would say the assumption there on the expense ratio, 30 basis points, once again, alpha generated through other wealth management themes more than anything else.
Okay. So would you agree that if you're given a choice between two products and they use the same benchmark and they have the same general mandate, to invest in, Canadian equities over the long term and to get, the best return they can net of fees, whatever else, that all else being equal, it's best to choose the cheapest one, or would you use some other way of making determinations? And if you would use other ways, what would they be?
Yeah. So I would say that headline costs, so the management fee, the MER are important. But I would say it's not the only determining factor. And here at Vanguard, and we have low cost products, but I think that also underscores the value provided by the investment manager, the liquidity of the product. So let's take an ETF, and so the headline costs are low. First of all, you just want to make sure that the benchmarks do in fact match up. There are benchmarks of Canadian equities that only hold the largest Canadian equities, tend to be more concentrated. Other benchmarks may hold the entire market or track the entire market. I think it's important distinction there as well. And then when you start to move into some of the other factors that go beyond that in an ETF, you'll have trading costs as well. And so how liquid the underlyings are, how liquid the ETF is, will create an additional cost. When you trade, you want to take that into consideration. And then I also think that there's this perception that passive management, that there's less skill involved, that there are no ways to add value within the passive management process. And I will say that when you've been a passive manager for almost 50 years, we take within that investment management process, every basis point and every fraction of a basis point makes a difference. And so we're very thoughtful about how we trade, about how we rebalance the portfolios, about how we handle corporate actions. All of that adds up to return over time, leads to better tracking to the index. So investors want to take into account, what does that investment management process look like and how well are they tracking the index? So headline fees, I would say just make sure that you understand what's in that benchmark. Headline fees are important. Trading costs are also important. How well the investment manager tracks to a benchmark, also very important. And then finally with us, as I mentioned earlier, we'd love to continue to bring down headline fees in the marketplace as we build scale and grow. And so continue to drive those down in the future.
So when you start talking about headline fees and trading costs and the various other things that go into managing a product, to me, the question that begs is, you have two main ways of coming out with products in Canada. Two different structures. You can use an ETF or a mutual fund. Why did Vanguard choose to come to Canada using ETFs when they largely made their name originally using mutual funds?
Yeah, I think there were a few reasons, John, for that. I think that one of the benefits of ETFs is that it really allows for, I think, greater access to our products. It allows us to reach more Canadians through the product structure. We still find that with our mutual funds, even today, we do not pay commissions, we don't pay trailers. We think that can create a conflict of interest. But having said that, that then limits our access with mutual funds. So ETFs as a listed security, we are able to reach more investors just in the fact that it is traded on an exchange. And it really, I think, removes any conflicts of interest, removes any commissions, any trailers. It is, in terms of just the ETF structure, it's beneficial from that respect. So that, I think, is really where we started here today.
So we began this conversation by looking backward and all the wonderful things Vanguard has done, since it was originally founded. I'm wondering if you can maybe look forward a little bit and tell me a little bit about either what you see as being the major initiatives of the company going forward, or what you see as being the major themes for retail investors as we head into the brave new world 2023 and all that might lie ahead.
Yeah, so I would say for us looking forward, I work with advisors, John, as you know, and I think we aim to, within the advisor space, continue to move beyond just a provider of what we think are world-class investment products and move towards providing solutions to advisors, being the advisor to the advisor. That might be through practice management, that might be through support for portfolio construction. So we have a number of tools and resources at our disposal, given the size of our firm, that we're able to bring to advisors. So I would say that's one. I would say within the as we think about investors, even direct investors through brokerage accounts, we do want to be an educator in that space and help support financial literacy going forward. And so look for us to really, I think one of the things that Vanguard does well, plain talk, really picking through the noise. And I think that's a relevant theme today when we hear themes regarding crypto or the 60-40, so the balanced portfolio being dead. We don't believe that. There's really, I think, enduring investment themes that we'll continue to preach about. Stay the course, financial discipline as we move forward here. So I just think the amount of information, the number of products continue to swell, and that probably creates confusion as well. Right. And we really want to help be a voice of clarity as we move forward. So that's really what you'll see from us going forward in the near future, and we look forward to it. I think in many ways we're still just getting started.
Yeah, it's funny because the great thing about the financial services industry is that it's constantly changing. And if you think you've got something figured out, chances are you're getting a little bit smug and overconfident about the way things are going to work, because the industry, it just never stops changing and evolving. New products are being brought to bear, but also new challenges in terms of the economic environment, and new insights in terms of the behavioral coaching and the things that advisors could do that genuinely help retail investors reach better outcomes. And I think it's the input from firms like Vanguard that actually help advisors do their job better, and frankly also help to educate the investors to help the investors be more discerning. So it can be a mutually supportive feedback loop that makes things better all around.
Yeah, we believe the same. We believe the same, John.
Yeah, great. So we're coming toward the end here. So the end that I do for every episode of the podcast, Tim, is I have two little things that I do that I ask all my guests to come up with. And the first is a section called That's Bullshit. And That's Bullshit is where I invite my guests to think of something, anything, that they think could be done differently and done better in the financial services industry. Have you got anything that you might want to draw attention to that you think if you could deal with things that you would deal with?
I would just say that I think it gets back to the point about I talked about the 60-40 being dead, the balanced portfolio being dead. That's something that we're hearing quite often from the industry. Movement to maybe other asset classes, alternatives. We feel like those can act more like equities in this market, but we don't think the 60-40 is dead. And going forward, we think that investors with a fixed income allocation will be well served. So I would say for that's where I would go with that one. Okay, well then
if 60-40 is not dead, and you want to call out those people who suggest that it might be, the second half of what I talk about is shift happens. And if it were up to you, what would you do to proactively, positively change those concerns that you just drew our attention to just a minute or two ago?
Yeah, so I think we're very data driven here, and I would say that if you look at the reset in interest rates here, we certainly recognize that the 60-40 portfolio and fixed income and equities for the first half of this year have been correlated. We find that those periods are usually short in terms of their duration, and that we anticipate that bonds and equities will be uncorrelated again in the future. We'll provide that diversification benefit. Fixed income will be a buffer to equities as we move forward. So I would just, we would encourage investors to, stay the course there, not to look to other alternatives that may create undue risk within the portfolio, and just take a long-term perspective to some of the noise that we're seeing here.
Great. That's a really nice way to end. Tim Hoover, thank you very much. It's been a pleasure having you on. Longtime supporter of Vanguard and a very long-time supporter of not just the company, but the company's mission and what it's doing. It's a real force for good in the marketplace in general and in the Canadian marketplace in particular. So thank you for coming on. It's been a pleasure having you, and hopefully we'll see you around soon.
Yeah, likewise, John. And we appreciate the ongoing support, and always great to talk to you.
All right. Take care. See you.
Bullshift, the podcast, was created in support of John DeGui's book, Bullshift, available now online and in bookstores everywhere. The comments and opinions are those of the author and his guests. They are for informational purposes and should not be construed as investment advice. John DeGui is an author, public speaker, senior investment advisor, and portfolio manager at Wellington Altus Private Wealth. For more information about John and his books, please visit standup.today. Bullshift, the podcast, is produced by TalkShoe, a division of IOTA.